Tax planning is the most overlooked aspect when it comes to retirement. And more often than not, if you ask your CPA a tax question, they might say, well, if it's regarding retirement planning, go talk to your advisor. And your advisor will say, oh, you have a tax question? Yeah, go talk to your CPA. And now you're at a loss and you don't have a ton of help. In today's video, I'm going to go through 6 core strategies to consider so you can save taxes in an early retirement and throughout retirement. Now, I'm going to explain, what does tax planning even mean? So most of the time, you are either your own tax preparer or you work with the tax preparer, and they're going to help file your return. They are doing what's called tax prep services. What they're not often doing is going, should we be doing Roth conversions and harvesting and charitable giving and healthcare subsidy planning and real estate and equity compensation and all this other stuff? That's what I do. So I do what's called tax planning, which is forward looking as opposed to simply filing the return. Now, tax preparers love me because I do all the tax planning, and a tax preparer is often busy trying to file 500 returns with the worst schedule in the world given by the IRS. So we often work well together. Most of the strategies I'm going to discuss today are going to be applicable if you are achieving an early retirement or if that's your goal. Because if you retire early, you have what's called a tax planning window. This is the time from when you retire, let's just say age 60, until Social Security gets turned on. That could be 62 or 70 or anywhere in between. And then required distributions are going to begin. That could be 72, 73, or 75. So we've got generally a 10-year window or so to be able to execute this tax planning intentionally so that you don't pay way more in taxes than you need the rest of your life. My goal is not to save you a ton in taxes in a single year, but to save you the most over the course of your lifetime, which often includes trying to save you a ton in a single year. If you don't already know, my name is Taublieb. I'm a certified financial planner. I'm the host of the Early Retirement Podcast, and I'm the vice president at Root Financial Partners. The first strategy I will go over is what's called a Roth conversion. This is where you are moving money from an IRA or a 401k, which is a pre-tax investment that you received a deduction for upfront. So assume that your income is $100,000. You put $20,000 into a 401k. Government says, Ari, awesome job. We're going to give you a deduction. So I don't pay taxes on $100,000. I pay taxes on $80,000. I get a $20,000 deduction this year, but as the money grows, you don't pay taxes on it until you take it out. Now, when you take the money out, you have to pay taxes. They want their cut somewhere. And so a Roth conversion is you saying, wait a second, I'm 60 years old right now. I'm retired. My income is really low. Maybe I should try to, on purpose, pay taxes at my current rate, which might be 15%, which is what the new rates are going to become. It could be 10 or 12% today, so that in the future, I don't have to pay 30% or 35% in taxes. It's essentially tax arbitrage. I call it cauliflower planning, which is I want you to eat a little bit of cauliflower today to avoid having to eat a lot of cauliflower in the future. In the future, you might want steak or pasta or different things. So on my screen here, I'm going to show you an example and a mistake that people often make. So here's a couple with $2 million. They have a primary home mortgage. They have an investment property. They've got a little bit of cash, about $3 million net worth. They are 60 and 57 with a 23-year-old child. And they're wondering, should I be doing tax planning? And you can see here, when we ran some basic projections for them, if they're executing quality Roth conversions, it could add about $3 million more over the course of their retirement. Yes, that is significant. But too often people go, oh, that's so cool. It comes with attitude. They're like, I already did the Roth conversion. I'm like, I wish you did nothing. Because if you do it incorrectly, it's still going to add money, but it's way less than if you're doing it efficiently. So there's a lot of different modes of doing a Roth conversion. But before any client starts getting to the fancy stuff that looks sexy because of these numbers, I'll say, wait, would you rather spend more? And they're like, what? I'm trying to do Roth conversions and tax planning. I'm like, no, I get that. But right now, you told me you wanted to spend $5,000 a month and retire at 62. What if you retired at 61 and you spent $10,000 a month? And the couple was like, well, that would be interesting. I mean, yeah, there's 7 million fewer dollars, but I'd still be okay. I'm like, what about vacations? Would you like to take more vacations? And they're like, well, that would be interesting. I said, humor me. 30,000 a year vacations, 100,000 a year for your child for a wedding. You're getting massages and all that good stuff throughout retirement. Just humor me. And they're like, kind of confused, but they're like, okay. And I said, look, there'd be 15 million fewer dollars. You'd still have 5 million. It's not 20 million, but watch what that does to your tax strategy. And I'll go back and show them now it does not make sense to do Roth conversions. So they're like, wait a second. So if I just spend more money, maybe it doesn't make sense to do tax planning? I go, to a point, there's a balance there, but too often people want to go right to the taxes. And it's like, hey, let's first see if we could spend more money first. Now, don't spend for the sake of spending, but if spending more money would add to the quality of your life, it's worth considering before you go do a Roth conversion, which is like surgery. Hey, let's first determine if surgery is needed. Don't just do elective surgery. So that's number one, Roth conversion. Number two is what's called tax gain harvesting. Now you can see I did a video on it right here where I talk about here's exactly how you can pay 0% taxes on 120,000 of retirement income. This is only going to be applicable to you if you have a brokerage account. So if all your money is in a 401k or a IRA or a Roth IRA, you can skip this. This is not going to be for you. But if you have a brokerage account, here's how it works. Let's assume that you are married, filing jointly, and your income is $0. You're 60 with $0 of income. That's unrealistic because you're going to have interest and dividends and things like that. But let's assume your income is $0 for just simplicity's sake. And you bought Apple stock for $10,000 and it grew to $100,000. That's $90,000 of growth. If you were to go sell Apple stock, you actually pay 0% taxes on the first $94,050. So you bought Apple stock for $10,000. It's now worth $100,000. $90,000 of that is growth. The first $90,000, you pay 0% taxes. You would still pay 0% if there was $94,050. Beyond that, you pay 15% in taxes. So when might this make sense? If you want to retire early and you have a brokerage account and you're wondering, should I do this and try to pay 0% in taxes? Or am I going to make more money by doing Roth conversions and moving money from my pre-tax 401k or IRA to my Roth? If you want a full case study on that, you can see I have different podcast episodes where I'm comparing the benefits. And when you want to decide what makes most sense, is it doing Roth conversions? Is it doing tax gain harvesting? How do you think through everything regarding tax arbitrage? Number three is called tax loss harvesting. You're going to be a whole lot more familiar with this. This is a very common phrase, tax loss harvesting. What I just told you a second ago is tax gain harvesting. So I'm intentionally realizing a gain to pay 0% or very little in taxes. Tax loss harvesting is if you've bought Apple stock for $5,000 and now it's worth $8,000, and you bought Coca-Cola for $5,000 and now it's worth $2,000. If you just go sell Apple stock, you have to pay taxes on the $3,000 of gains. But if you sell Apple stock, 3,000 gains, and sell Coca-Cola, 3,000 losses, they offset one another and you don't have to pay any taxes. So what you're doing is you're essentially going, I want to be intentional here. I've got some winners, but I also have some losers. Can I maybe offset that to reinvest more intentionally without paying taxes? Number four is charitable giving. If charitable giving is a big part of your plan, you might want to consider a donor-advised fund. Here's why. If you are currently taking the standard deduction every year instead of itemizing, and you're giving $5,000 every year to a charity, you're being very nice, but you're not getting a tax benefit for it. Versus if you said, I want to give $5,000 a year to the Red Cross, and hypothetically, you bought Apple stock for $5,000 and now it's worth $50,000. That's a big gain there. Versus if you were to go sell that, maybe you'd end up with $40,000 after paying capital gains taxes. So what you might want to do is go, wait a second. Maybe I take the Apple stock position, give it to the Taublieb Giving Foundation. So I set up my own foundation. I take the $5,000 I purchased for, grew to $50,000. I give that to me, my own foundation. I give $5,000 a year out of the Giving Foundation. So all I did was say, I'm going to get a big tax deduction this year. I'm going to essentially say, Well, I give $5,000 a year to the Red Cross every year, but I don't get a tax benefit for it. Why don't I give $50,000 or 10 years worth of giving to the Red Cross? So $5,000 a year times 10 years, $50,000 a year, $50,000 total. And now the government goes, Ari, you're so nice. Oh my gosh, we're going to give you a huge tax deduction this year because you just gave appreciated stock to your own foundation. You can't give it to your kids or your fiance or your water bottle. You can only give it to a 501c3 organization. So the government's like, here's a big deduction. And all I didn't change anything. The charity gets more money because now they get 10 years worth of giving versus, let's say, 9 or 8 years. Because if I had Apple stock, $50,000, and I had to pay 15% capital gains on it, well, the charity gets less money, so I'm not happy about that. They're not happy about that. I don't get any tax deduction for it. So charitable giving can be an awesome strategy to actually minimize your tax liability. That's level 1. Level 2 is, whoa, what if we pair that and intentionally do that charitable giving strategy in the same year my income is low when I need to do Roth conversions? Whoa. That's the next level to this. Number 5 is pulling from the right account to minimize taxes. If you are pulling from an IRA in retirement, you have to pay ordinary income taxes on the schedule on my screen right now. It could be 10% or 12% or 22%. So a lot of people come to me and they're pulling from their IRA or their 401k. That's a 22% tax rate. If your income is between 94 and 201,000, that's just federally. Versus if you have a brokerage account, you're only paying 10, 15, or at the most 20% plus a 3.8% net investment income tax. So you want to be really intentional as to which account you pull from in retirement to minimize your taxes. And then finally, Social Security. Most of you are going to fall in one of two buckets. Number 1, yeah, I've been paying into this thing for a long time. I don't know how much longer I'm going to live. My parents wish they collected earlier. So I'm going to turn that sucker on at 62 as early as possible. Who knows if it's going to get reduced? Oh my gosh, I don't know. I'm just going to turn it on. Maybe I could take the money and invest and do even better. That's some of you. Others of you are like, look, I don't know how long I'm going to live, but if something happens to me, I want my spouse taken care of. So if I pass away, I want them to get the biggest benefit for the rest of their life. So I'm going to delay and wait until 70 or full retirement age. That's most of you. You fall in one of those two boats. They're both wrong. Now, they're not wrong in that if you picked one, you wouldn't be okay, but they're not optimal because as soon as you turn on Social Security, well, that's more income coming in. So that means there's less room to effectively do things like Roth conversions, which could literally add hundreds of thousands, if not millions of dollars. The right versus wrong Social Security decision, as you can see on my screen here, can be the difference oftentimes of hundreds of thousands of dollars. So if you want to be able to optimize your Social Security decision, your conversions, your estate, everything I'm talking about today, you can see there's a summary with your specific strategy. It'll tell you how much income you might get over your lifetime from Social Security, when you should collect, when is it optimal, everything based on your current plan. If you want to have access to all of these tools, you can go ahead and find that inside of the Early Retirement Academy. You get access to everything I'm discussing with you today and more. So to summarize, number 1, Roth conversions. Number 2, tax gain harvesting. Number 3, tax loss harvesting. Number 4, charitable giving. Number 5, withdrawal strategy. And number 6, Social Security optimization. These are the 6 core tax strategies that if you want to make sure you don't pay more than you need to in taxes, and you don't want to get killed in taxes, you are considering these strategies. Now, once again, these strategies are often difficult to actually execute on your own. If you want to do it in an optimal fashion, that's why people like me exist. I love getting to do this type of planning. If you want to work with one of my advisors on early retirement planning, you can apply to work with us in the description below of this video. You can also go ahead and access these tools if you just want to start playing around with this right away. And if after you find you want to work with an advisor at Root, you can certainly do so, but this might be a good starting spot. So just options for you guys. Check it all out in the description of this episode. If you found this was helpful, please like this, please share it with someone you want to retire early with, and subscribe so you don't miss any content like this.